All right, let's talk about the recipe of becoming a crorepati. Now, everybody wants to save tax, retire early, and become a crorepati, but then very few would know and understand that it cannot happen in one night, obviously. Now, you've got to build a lot of wealth for that, which also needs a lot of patience and understanding of investment instruments and products. So, how can you, a common man, hop on to crorepati's wagon? Is it possible to achieve the big financial independence dream via tax-saving investments? Let us find this out, and we have Santosh Navalani, COO of the ET Money. Santosh, good evening. Welcome to the show. Being a crorepati, now that's a very common theme that we also find out when viewers send us our queries, especially when they are lining up their financial goals. I mean, the corpus that you want to accumulate is mostly in crores. But then, do you really think it is a distant dream, or now with the help of the right financial planning, it's easy for you to become a crorepati and not just participate in a KBC and then, by just a miracle, you might become a crorepati?
Hi Kavita. So I wish I knew this when I was a bit younger. I discovered this a bit late in life, but nevertheless, when I discovered this, it was quite astounding to know that it's actually quite easy to retire crorepati. I wouldn't say that it's very easy to become a crorepati at a young age, but it is actually quite achievable for most of the Indians, if not all, who are working in corporate setup or are self-employed or actually are earning at least 10 lakh rupees per annum, who can afford to save enough and accumulate enough savings. So the point is not about which asset class gives you that chance to become a crorepati. It's about how much time you can give. So if all of us are supposed to give time to investments, but very few give, it's the reason why not everyone is crorepati. So at the moment you decide that there is one way which government of India has opened up for every citizen in India, which is tax saving investments, it becomes quite easy and doable. Because every year what you cannot escape is paying taxes on your income. And most of us want to save extra, work extra hard, or do extra bit to save as much as possible. Now, Government of India has given that chance to everybody, and if you take advantage of those chances, then one thing is for sure, that everybody can retire a crorepati.
Right. So now the recipe or the miracle formula that you are going to talk to us about of becoming crorepati is achievable by just having tax-saving investments in your portfolio. Is that right?
Yeah, so there are multiple ways to become crorepati, but I think one of the sure shot, most accessible ways to actually use all your tax saving investments opportunities and possibly become a crorepati. Yes.
All right. So how should one go about it, and what investment instruments are you actually talking about? Because if we talk about tax saving, which includes ATC, it has a lot of investment instruments. There is a debt portion. You have equity also. So what exactly are we looking at?
So the good part, Kavita, is I think Government of India has given all three asset classes to Indians to actually choose their preferred asset class or mix and match if the need be, and choose their own path to becoming a crorepati. But the formula is simple here, right? Ultimately, is the rate of interest, the amount you invest, and a number of years you're willing to give. These three things together decide. But the amount, even if you want to invest more, is not possible because most tax saving instruments are capped at 1.5. In fact, all tax saving instruments except NPS is capped at 1.5 lakh rupees investments per annum. So why you can't control that, what you can choose and plan is what kind of interest rate or return that you're comfortable with, and what kind of tenure you are aiming for. So depending on the tenure that you're aiming for, you can choose your investment avenues, and the options range from pure debt portion like a public provident fund or employee provident fund. Second option being equity ELSS schemes, which we are all aware of. In fact, we discussed at length yesterday. And the third one is NPS, which actually has the best of all worlds, where you can combine not just equity, but also government securities and corporate debt, and even REITs, real estate investment trust, into one product, and try to become a crorepati. So we can talk about PPF to begin with, which is possibly the most popular option for most Indians. And it's important to know that everybody can invest up to 1.5 lakh rupees each year into PPF. So if you optimize that and say that I want to invest 1.5 lakh rupees each year, and if you assume the current interest rate, which is about 7.1% per annum, it will about take 25 years for you to become crorepati, condition that you invest 1.5 lakh rupees every year. And if that is 8%, if interest rates go up and you start getting 8% consistently, then in about 24 years you can become crorepati. Now, good part is this sovereign debt. It's guaranteed by Government of India. There is no default happening in this. You're bound to get your interest payments and your principal back. So there's a short way of becoming crorepati. The only thing is it takes a bit more time to become a crorepati, which is 24 years or 25 years. But again, before everybody can afford to retire, and if you are starting this at 25 years of age and assuming you work for 35 years, this amount can become 2.8 crore over 35 years.
So, if you're talking about PPF or other tax saving instruments, we are talking about investing almost 1.5 lakh yearly. And if you talk about PPF, we also know that there's a quarterly review on the interest rates. The kind of interest that you're talking about is somewhere around 7%, which has to be constant throughout your investable duration.
Yeah, of course. So there is no guarantee that 7.1 or 7% will remain constant throughout the journey of 25 years that you would spend. It may go up by a little, it may go down by a little. But if we are an economy which is growing at around 7% per annum over next decade or so, at least you know that most of your investing tenure, you might get that kind of interest. It's simply because the inflation, most of the time the PPF rates actually tend to be around inflation or slightly higher than inflation. So unless India becomes a low inflation economy of less than 4%, there is a very little chance that this interest rate is going to go down towards that number. So of course it may go down towards 6, may go towards sub 6% as well. In which case, of course, your tenure will probably rise. And if you believe that India is going to be a developed economy in the future, and once interest rate will go down, then of course you should be looking at equity-based investment opportunities like ELSS, or maybe a hybrid opportunity like NPS.
And also, this money is exempt.
So PPF is exempt, Kavita. There is no at no point of time you get taxed. So your investment is tax free. So if you're 30% tax bracket, you roughly save about 46,000, couple of hundred rupees, including surcharges. And the entire accumulation phase in your PPF and contribution phase, all interest income which gets added to your PPF corpus actually is tax free, and when you withdraw the money is tax free as well. In fact, it's good to know that only PPF is a fully triple E product in the country available today amongst tax saving instruments. Rest all products actually have some amount of tax at the end of the period.
All right. So the time duration or the years required would be what, 25 to 35 you mentioned for a PPF?
So 24 years if you assume
okay.
the 7% to be constant, and 25 years if it increases to 8%. If it goes to 6%, I guess it would be in the region of about 27, 28 years.
Let's move on to ELSS. We've discussed about this yesterday, but then what about becoming crorepati? How much of an interest would you want your fund to earn for you so that you can become like a crorepati in 20 years maybe?
So, if I think with ELSS we can be a bit realistic here or conservative. If you look at Nifty's returns, Nifty has returned about 12% or so on a rolling basis. If you look at 5 and 7 year periods, and we can assume that as a conservative figure that you would possibly earn from equities over long periods of time. At 12%, one can easily become a crorepati. Like if one contributes an SIP of 12,000 rupees 500 per month, which approximately helps you save about 1.5 lakh rupees as per Section 80C. So this 12% XIRR in your SIP for 12,500 can make you a crorepati in 19 years actually. Again, far earlier than you would actually planning to retire. So if you start at 25, I'm sure at 25, most people may not be able to afford an SIP at 12,500 rupees. So maybe you would possibly start that amount at 30, at the age of 30, and by 50 you can actually comfortably can aim to become a crorepati if you get your funds right, if you get your performance right, and of course your commitment and discipline to stay invested and doing that 12,500 each year.
Let's move on to NPS. Now, we all know that NPS have a variety of schemes, a selection that you've got to make to become a crorepati. Should it be a mix of equity and debt, or it can be a pure equity selection, which it's not that available in NPS? I mean, you need to have some component of debt in your scheme selection. So how can one go about it?
So I think in NPS, Kavita, the max you can go in equity is
Right.
75%. Though one added advantage is in NPS, you actually can invest up to 2 lakh rupees and claim tax reduction, because there is separate carved out section for 50,000 rupees additional investment over and above section 80C. So if you invest about 16,600 rupees and utilize that entire 2 lakh rupees limit, then you can actually kind of aim to become a crorepati in within 18 years or so. Now, that assumption here is simple, that you actually are contributing higher than ELSS. In ELSS, we're assuming that because the limit is only 1.5 lakh rupees, you're investing only 12,500. In this, your investment amount becomes, or opportunity to invest higher amount increases. And because it's a mix of multiple investment options, the return can tend to be bit lower than full equity, because there is debt instruments compulsorily added into this. So if you assume a return of about 10%, which is conservative, realistic estimate in my opinion, you can aim to become a crorepati within 18 years or so. Again, much lesser than many of us would aim to retire if you start early. The key is before you retire, or about when you're about to retire, you can become crorepati with these kind of products. So in NPS, one thing which to know is the equity cap is about 75%. You cannot exceed 75% limit. In fact, after age of 52, the equity amount, even if you opted for higher 75%, starts going down automatically and it aims to become like towards a conservative estimate about 20% or so, I guess, by the time you become 58.
Okay, but then what about your withdrawals? As in, if you become a crorepati, if you've accumulated that corpus in crores, how can you withdraw? And when you withdraw, what is the kind of a percentage that's tax free for you?
So, as we discussed, PPF is triple E. So, PPF goes out completely, it's entirely tax free in the hands of the investor. In ELSS, because about 2 years ago, the income tax, or like the long term capital gains tax, was modified, and from zero it was brought up to 10% of over and above 1 lakh rupees of capital gains in a year. So, technically speaking, because we are talking about crores here, you would actually be liable to pay tax on the gains that you have made. But over here, there is something smart possible, that every few years, as and when you have 1 lakh rupees of tax-free corpus available, you actually can withdraw and reinvest and possibly earn tax-free gains of 10,000 rupees. So that way you can actually reduce the tax liability every year by utilizing that 1 lakh rupees of long-term capital gains limit. So of course, nevertheless, there is a taxation at the end of the year of entire corpus that you will be actually withdrawing. If you withdraw all at the end, will be subject to 10% of taxation on that side. With respect to NPS, it's a bit different here, Kavita, where in NPS, there is a limit that you cannot withdraw more than 60% at the time of retirement. So while the 60% that you take out entirely is tax-free, the 40% amount that you will have to stay back or stay invested in NPS would have to be compulsorily converted into annuity product. And then annuity will be, is the current taxation rules are such that entire annuity that you receive, which is monthly income or monthly pension, is taxed in the bracket that you belong to. So even if you are a kind of, a 30% tax individual at the age of 60, then technically you will be subject to about 12% tax. But we should not forget that you actually got an opportunity to save up to 60,000 rupees in taxes each year of contribution when you invest 2 lakh rupees in NPS. So I don't think the taxation in the end in the end of the tenure for any of these products should be a point of consideration, because if the opportunity for you as an investor is, if you don't invest in this product, in which product you will invest, and if you invest, the fact is taxation may be higher in those products. So you are far better off not to bother about the tax in the end and focus on the amount you can invest, the returns you can generate for yourself by being smart about it, and actually staying invested throughout the period so that you can actually have a larger corpus.
All right. So, you want to become a crorepati, and if tax-saving instruments or investment strategy is your way, then PPF, ELSS, and NPS are the three options that were explained by Santosh. Thank you so much, Santosh, for being on the show and explaining this in detail to our viewers.
Thank you.